Good morning and welcome. Today we're going to explore four interconnected themes that reveal how global financial markets, geopolitical tensions, and economic strategy are all deeply linked. Think of this as a map. Each topic is a landmark, and by the end, you'll see how they all connect into a single, coherent picture. Let's dive in. Let's begin with what may be the most significant financial event of the decade, the SpaceX Initial Public Offering, or IPO. But first, what exactly is an IPO? When a private company decides to sell shares to the general public for the first time, it launches an IPO. Think of it like a restaurant that has always been family-owned, but one day decides to sell part of the business to outside investors in exchange for capital to grow. SpaceX's IPO is projected to be the largest public stock offering in history, nearly doubling the size of any previous listing. To put that in perspective, Saudi Aramco's IPO in 2019 raised around $25.6 billion and was considered monumental. SpaceX is expected to surpass that significantly. Now, here's the key insight. For such a massive volume of shares to be successfully placed with investors, market conditions must be favorable. Imagine trying to sell umbrellas on a sunny day. It's possible, but much harder. In financial terms, nobody enthusiastically buys into a major stock offering when markets are falling. Investors need confidence, and confidence grows in rising markets. This leads us to an important interpretation of what we're currently seeing. The pullback in technology stocks that many analysts are calling alarming is, in this reading, not the beginning of a prolonged bear market. Instead, it looks more like a deliberate and healthy correction, a natural retracement after the strong rally that ran from April to October 2025. Think of it like a hiker climbing a steep mountain. Occasionally they stop, catch their breath, maybe take a few steps back on a tricky section, but the destination hasn't changed. Many institutional investment funds appear to be selling existing positions precisely to make room in their portfolios for SpaceX shares. Regulators have even adjusted legislation to accelerate SpaceX's inclusion in broad-based indices, a remarkable step that underlines just how significant this offering is. Elon Musk has announced that 30% of the SpaceX IPO will be reserved for retail investors, everyday people like you and me, rather than large institutional players like pension funds or hedge funds. In most large IPOs, retail investors typically receive between 5 and 10% of the total offering, so tripling or even sextupling that allocation is a significant departure from standard practice. The official narrative is that this rewards Musk's loyal community of supporters, but in finance, it's always worth asking, what is the structural incentive? Here's a useful analogy. Imagine a bakery that bakes 10,000 loaves of bread in one day, far more than usual. To sell them all, the baker opens the doors wide to individual customers. The goal isn't generosity, it's distribution at scale. Retail investors, unlike institutional ones, tend to react more slowly to price declines. A pension fund manager who sees a 15% drop in a stock will often sell quickly to protect capital. An individual investor who bought SpaceX shares out of admiration is far more likely to hold on, hoping for a recovery. This behavioral difference is critical. History offers us a sobering pattern. After major, hyped IPOs, think of companies like Uber, Lyft, or even Facebook in its early days, the stock often struggles in the months following the listing. The pre-IPO excitement fades, early investors take profits, and the price corrects. Retail investors, holding on out of loyalty or hope, frequently bear the brunt of that correction. This is not to say SpaceX will necessarily follow that path. It's a genuinely extraordinary company. Gold has fallen sharply in recent weeks, and many investors are worried. Is gold losing its status as the world's ultimate safe haven? For thousands of years, gold has served as a store of value, a way to preserve wealth across time and across currency crises. When paper money loses value through inflation, gold historically holds its purchasing power. It is, in many ways, the financial world's ultimate insurance policy. The primary driver of the current decline is straightforward. Sovereign funds, central banks, and governments facing liquidity constraints are selling gold to raise cash. They're not selling because they've lost faith in gold, they're selling because they need money now. Think of it like a homeowner who loves their house but needs emergency cash. They might sell some jewelry or a second car, not because those things have lost value, but because liquidity is the immediate priority. A particularly illustrative case is Turkey. The country is caught in a difficult economic spiral. Inflation is running above 30%, the Turkish lira has been on a long-term downward trend, and as the currency weakens, the cost of imported goods rises, which feeds back into inflation. It's a vicious cycle that's extremely difficult to break. To slow the lira's decline, the Turkish central bank made a decisive move. It sold gold and used those dollars to buy liras on the open market. According to Bloomberg, Turkey sold 58 tons of gold since March 13th alone. That's an enormous quantity, roughly equivalent to the annual gold production of a mid-sized mining nation. But here's the crucial detail. Many of these sales are structured through swap contracts. A swap means the central bank sells gold today with a contractual obligation to buy it back at a future date. The gold is temporarily lent to the market. It will return to Turkey's reserves once the crisis eases. The same dynamic applies to Gulf nations. Unable to freely export hydrocarbons due to regional conflict blocking key shipping routes, these countries are liquidating gold reserves to cover government expenses, with full intention of rebuilding those reserves once conditions normalize. The investment conclusion is significant. If gold is falling not because of lost confidence, but because of temporary forced selling, then this sell-off may represent a rare and compelling buying opportunity. Now let's zoom out to the biggest picture of all. At the heart of current global events lies a strategic competition that goes far beyond any single regional conflict. Iran presents a fascinating paradox. Despite confrontation with the United States and Israel, Iran is selling oil at elevated prices. By controlling key maritime choke points, particularly the Strait of Hormuz, Iran is effectively blocking its Gulf neighbors from exporting their own hydrocarbons. Russia finds itself in an unexpectedly favorable position. Prior to the Gulf crisis, Russia had to navigate complex Western sanctions. Now, with global supply disrupted, Russia can sell oil freely and at high prices. This comes at a critically important moment. The war in Ukraine has severely strained Russian public finances. Putin has reportedly asked Russian oligarchs to make voluntary donations to the state to help fund military operations. The United States is also benefiting significantly. American energy producers are exporting hydrocarbons at scale, taking advantage of elevated global prices. This represents a major economic gain at a time when the domestic economy continues to grow at a solid pace, as evidenced by strong indicators like surging air travel demand, with more passengers seeking flights than there are available aircraft seats across the country. Saudi Arabia is generating enormous oil revenues, with ships literally queuing up to load Saudi crude. But the most revealing data point isn't the volume, it's where Saudi Arabia's oil is going. The answer, overwhelmingly, to Asia. This single fact carries profound strategic implications. Asia, and particularly China, is the primary victim of the Gulf crisis. Consider the numbers. Approximately 25% of Chinese industrial enterprises are already operating at a loss, with the remainder surviving on razor-thin margins. Energy is the bloodline of industrial production. When oil prices rise sharply, manufacturing costs increase across the board, from plastics to steel to transportation, and profit margins compress further. This is happening while China's industrial ecosystem was already under pressure from trade tariffs. The message to global investors and manufacturers becomes compelling. Relocate to the United States, where you will find security, abundant and affordable energy, and a stable legal environment. Whether one agrees with this approach or not, it's important to recognize it for what it is, a coordinated economic strategy, not merely a series of random events. Understanding these forces gives us the tools to read the world more clearly. It's worth pausing to consider something more fundamental. Every day, we're bombarded with news about conflicts, but it's worth asking, are we seeing the full picture? The real human cost of any conflict is borne by ordinary civilians, families displaced from their homes, workers who have lost their livelihoods. These are the voices that deserve to be centered in our public discourse, not the strategic calculations of distant governments. Financial literacy and geopolitical awareness aren't just for experts. They are essential tools for navigating the modern world, tools that help us distinguish between noise and signal, between fear and opportunity, between propaganda and analysis. That is the goal of this kind of education, not to tell you what to think, but to give you the frameworks to think more clearly for yourself. Thank you for watching, and keep asking the right questions.